Hello and welcome back to the Walk Around Podcast. This is season 3 of our little show, and we are back with some changes in the new season. Sitting beside me is Jonathan Jordan, one of our new co-hosts. Throughout the season, we're going to have some new guest co-hosts join us for the conversation. And Jonathan, you're familiar with the Walk Around, are you not?
A little bit. A few years ago, I think it was episode 22.
22.
Yeah.
Yes, one of the best. We all know 22.
I'd like to think so.
Yes. And now you're a host with me.
Yeah, we'll see how it goes.
Okay. Tell us a little bit about your background in automotive.
I've been in automotive. Next year will be 20 years. But the last 10 years with JM&A. I work on the retail strategy team here at JM&A, which I like to say means I get to do a lot of the fun stuff, focusing on kind of how our products are sold and how they're going to be sold in the future. The first 5 years of my career with JM&A was on our sales team, most of it up in the Northeast, and prior to that worked in automotive retail.
So you're definitely a veteran of the industry, and that'll bring great conversation and insights to our season ahead. And you're joining us for our first guest with George Karolis. George is the president of Presidio Group. And if you don't know Presidio, they are an investment banking firm focusing on mergers and acquisitions within the automotive retail space. And we talked to George about the Presidio's Automotive Trends Report, what they're seeing in the industry, the market. I think George shared a ton of great insight.
I agree. It was really good to get his perspective on kind of what dealers are looking at, dealers who are thinking about selling their stores, dealers who are thinking about growing their business. And he gave some really good perspective around F&I specifically in that space.
And we introduced a new segment called Best Bets. Now, I'm not sure George loved it, but I certainly had a good time with it.
Mark had a blast. I'm not quite sure, but let us know what you think.
We're working through it, okay? It's a new segment. Check it out. And we look forward to your hearing our conversation with George Karolis. Well, George, welcome to the Walk Around Podcast. It's great to have you join us and to be our first guest of the new season. Thanks for taking the time.
Well, thanks for having me. It's an honor to be here with you guys.
Thanks, George.
So let's jump right in kind of to your background, George. For my research, heavy research, which is just really a LinkedIn page, your background started in finance, non-automotive. How did you make that jump from the finance world into retail automotive?
I won't bore you with too many details, but I did start my career at Arthur Andersen, one of the biggest accounting firms at the time that no longer exists. And I was in their transaction group. So we helped clients that were buying businesses, helped advise them and helped them through transactions. And one of my clients at the time was a private equity group that ultimately was the founder of Asbury Automotive Group before it went public. Found myself supporting them and helping them acquire the deals that ultimately were the foundation for Asbury to get its start. And one thing led to another, and found myself working 100% of my time on that stuff. And Asbury realized that this business was a longer-term play and harder to flip, if you will, at those times. This was the late 90s, and decided to build a corporate team and a corporate office and take the public company route. So they brought me on, and it was sort of history from there. I was at Asbury 18 years and helped them, acquire many of the dealerships that they still own today. They've been in super growth mode in the last few years, of course, and done some deals with them on the other side. Great folks, and that's the kind of the quick and dirty on it. Nothing too fancy or exciting, but it was really exciting and fun to be a part of a big organization that was in growth mode like that for so many years. And now to be on the other side to sort of work with clients of all sizes, dealership groups of both private and public of all sizes, really, really fascinating.
So what do you think, George, in terms of the transition into automotive, and you've been in the business now for, like you said, you were with Asbury for 18 years. What are some highs and lows? What's your perspective on retail automotive?
Well, there was a pretty decent wave of consolidation in the early part of the 2000s. From call it '01 to '05. Not a lot of folks remember or talk about it. It was different than today for sure, but companies were, rates were low, and companies were acquiring, out there acquiring deals, and sort of, that first wave of really good values for deals was during that time period. And it was mostly the publics at the time. There were a lot of privates doing deals, but it was kind of quiet. There wasn't the reporting that there is today. But that was a wave for sure. And then the lows would be, the Great Recession in '08 and '09 when things really just went to a halt. And, every day, working at a public company, you had to, learned a lot, and going through that, you learn a lot of things from tough times as well. And, you're trying to figure out how to keep the lights on and manage your OEM relationships and manage not having too much inventory when folks weren't really buying vehicles. So you learn, you learn a lot of good things in tougher times. In really easy high flying times like the last few years through 2022 certainly, and into 23, dealers are flying high, as we all know. We don't have to regurgitate that, but double, triple historical profit levels never seen before. And with that, you could develop some bad habits and get a little loose, and not have to worry about focusing on the basics. And so we're evolving in what we call the great normalization now, back to having to have some more discipline. And we say that dealers have to work now a little bit harder to make a little less money in the times we're in now, but things are still really good.
I love that term, the great normalization. Did you guys coin that? Have you trademarked it? Is that a Presidio original?
We coined it. I don't think we're going to trademark it per se, but we did come up with that sitting around a table when we decided that we would launch our robust quarterly report, which has a lot of different information, and we try to really be students of the industry and be thought leaders in the industry to give a different take and perspective on auto retail and the sort of the current factors and drivers, and like what's happening and what the outlook looks like. And so as we're sitting around the table and looking at data and information, and we have a lot of clients and dealers we work with too, so we have a lot of data information. On top of that, we sort of see this, we hit this peak, and then we're kind of going through this period of change and earnings coming down, if you will, and gross is coming back to more like normalized levels, if you will. That word normalized kept coming about, and we said, well, we need something catchy here to talk about the period we're in, and I think I don't remember who came up with it on our team, but it was kind of like really the right statement that kind of captures it all.
I think, George, that makes a lot of sense, because it's been a roller coaster, the last couple of years. And I think sometimes we have to put things in perspective, because I think it'd be easy to compare this year to the last couple of years and think, oh no, kind of what's going on in our business. But when we kind of put it in perspective, it helps. One question I have, like we talk about the great normalization, what's normal? Like, and what's, what are you guys looking to really determine kind of what is the baseline? What should we be what bar should we be chinning up to, as an industry?
That's a great question. I wish I had the answer to that. No one has the answer to that, right? We believe every dealership is unique and has its own really unique characteristics, right? And there's so many driving forces behind this great model, brand and geography and competition, things like that. But then the uniqueness of each operator bringing their own spin to that business. The franchise model is incredible. The dealer laws are incredible. And so this is a really robust, vibrant, viable business. Last year didn't feel good. The first quarter didn't feel good. Overall, the industry's profitability was off about 20%, 2023 versus 2022. And that's, we have a partnership with NCM where they share data with us there are over 4,000 dealerships, aggregate data, nothing specific to any store. And so that's where that data comes from. And so it's, a good cross-section, nearly 20% of the dealers in the country. And so it doesn't feel great, but it was still about 2.5 times higher than pre-COVID earnings levels.
Right.
And so, we are probably in a little bit of a new normal where brand and geography matter much more than ever. as we face these kind of headwinds and changing business with inventory levels really coming back, and then consumer demand shifting, of course, with all the interest and inflationary pressures out there. But it's more of a unique nature of each dealership business that kind of is going to drive the metrics and sort of story for each dealership more than ever. In 2001 and 2002, anyone could sell anything, right? Because there was so much more demand than there was supply of inventory. And so things were easier. Now we have to differentiate ourselves some and focus much more on the basics and drive profitability from a different perspective.
So, George, let's get into the report. And you referenced that your newest report has come out, and our listeners can see that on your website, right? PresidioGroup.com. And let's get into a little bit of dealership value. We've seen crazy numbers over the past couple of years, as you kind of referenced. Are dealerships actually worth what they're selling for? And what do you think determines, or the best factors that determine that? I know you guys have your own kind of methodology of valuing dealerships. Talk a little bit about that.
Yeah, sure. It's funny. I always like to lead in with this. We speak to dealers regularly. We get calls from dealers almost every day. And every now and then that call it goes like this. Hey, I make this much money and this is my brand. What's my dealership worth? And my answer is, I cannot tell you that. And anyone that tells you that, you should hang up on them, right? Because every deal is so unique. To your question, your first question, what are these things worth? What the numbers we're seeing? Well, they're worth what someone's willing to pay, what to sell for, and what someone's willing to buy for. And there are such an amazing industry. There's over 18,000 dealerships, over 8,000 owners, and we're 6% consolidated by the public still. And so still quite fragmented. Literally hundreds and hundreds of buyers out there. Successful dealers, strategic buyers looking to, expand and grow their portfolios. Look, there's with on the flip side of that, there, because of how many dealers there are and owners in various stages of their business cycles and ownership cycles, there's always those that want to sell. And so it's a really nice model and balanced model. But what we hear so many times from dealers, a lot of private dealers, is that this is the only thing they really know, that this is the only place they really know how to make money. And each has a different, unique kind of spin and perspective on how to operate and the secret sauce, if you will. And so, from that end, every buyer will look at a deal differently than the next. It's sort of really interesting. We have a very sophisticated approach to valuing dealerships. Again, the uniqueness of each dealership. So there's no cookie cutter approach, but we start with what we call a Presidio valuation matrix, which has over 10 kind of key factors. And you can see this in our report, but it's brand and geography and competition and sort of density and UIO and things like that. And then the quality of earnings of any dealership is really the most important thing. People in the industry likes to focus on blue sky multiples, which is a mistake. It's that's just simple math. Multiples literally have not really changed that much, within a couple points over time, literally in 20 years. So the multiples really don't change very much, but it's all dealers sometimes want to focus on. Yet the most important thing, the biggest piece of the equation, is what are the earnings, and what is we call this sustainability of earnings, so quality of earnings. How to predict what those will be into the future, right? Because ultimately, what really matters is your return on investment, which is how much you make versus what you invested in business. And predicting that and determining that is really sort of the biggest challenge, and it's the toughest thing to do in the times we're in now, where nothing's normal, like we said earlier. Right. But there's during the height of 21 and 22 and dealer profitability, there were some dealers that had supersized, outsized margins, if you will. Like maybe we're making way too much money selling vehicles, well over MSRP, things like that. And in cases like that, where most of their earnings were being driven by variable gross profit, that might be less sustainable than the business that was Steady Eddie, was making good money, more money than ever, selling vehicles and good margins, but not taking advantage of customers, not selling over MSRP. And their fixed business was robust and had a loyal customer base where their fixed gross was a bigger portion of the total pie. That would be a less risky, maybe more sustainable type of business to look at as we predict this normalized world that we're in. And so again, unique, each is unique, and those factors, those kind of global factors and then micro factors within each dealership. We think about this, the three Qs of earnings, three Qs of earnings, kind of quality of people. That's the employees and the team and the culture, quality of facilities, and then ultimately the quality of earnings, which is circular to those two things. Those other two things sort of help drive that. And right, so those are the three key things we see lots of really sophisticated dealers, buyers, investors focusing on in terms of figuring out how to value and land the big ship of what that earnings profile looks like into the future.
When you look at quality of earnings and probably quality of people too, how much does F&I come up? And how much is that a focus?
Huge. I mean, it's interesting. We actually think of it as sort of lower hanging fruit, right? It's you don't need a new customer to generate F&I, right? F&I is generated because of vehicle sales, right? And so it seems to be one of the bigger focus areas as stakeholders evaluate deals. They'll look at what F&I PVRs are and see if there's opportunity for growth. And the best dealers employ best practices. The ones that generate the best F&I, they employ really best practices, have robust training programs in place, have really great digital and menu tools employed, and have a really systematic approach to it, to not leave anything on the table. And so. Interestingly, though, a lot of buyers are looking for opportunities. They'll say, okay, I have opportunity because I could do better in F&I, right? And the beauty is in the eye of the beholder there. And it's a huge topic. F&I, interestingly, in our NCM data for 2023, while, new vehicle margins were down over 27%, F&I PVR was only down around a little over 7%. Mm-hmm. And so that really helped mitigate some of this downside that we saw, right? Kind of keeping that ship steady. And so it's a huge focus for sure.
So, George, if you're a dealer listening and you're thinking about kind of the next several years and you're thinking, maybe this might be the right time for me to sell, would your advice be to focus on those three Qs that you mentioned? What should a dealer be thinking about if they're ready to get into the selling market?
Yeah, that's a great question. Overarching, we always tell folks this: if you want to sell, if your plan is to sell, it's actually better to be 2 years early than 1 day late. Right. So that's the first piece of advice we give folks, because I've actually been in the industry over close to 25 years now, seen over 25 years with the Arthur Anderson experience, have seen cycles where you snap your finger and it's a buyer's market, or there's not demand for dealerships anymore, and it changes like drastically and quickly. We're still in a seller's market, but it is changing, right? It's brands and geography are really the bigger focus and matter more now than ever. And but the deal is changing, and it's changing quickly, and so that's the first big piece of advice we give. Don't wait. But if you have a little bit of a plan and you want to sort of, optimize the business, there's not a ton to do that, because a business is what it is, and the story will be told for the long term. But, focusing on your facilities, making sure they're in order, making sure there's no legal constraints, that would impede a deal, making sure the team's in place. Oftentimes most buyers, we hear this from most buyers. I used to say this as one of the bigger buyers when I was at Asbury. We don't have a bus full of people waiting to go to work. The hardest thing to do is find good people to work at dealerships. And so buyers really focus on team and tenure and turnover. And so the deals with really sort of great cultures and great teams and low turnover and longevity and good business practices seem to do better. And and you actually also see it in the numbers, right? It's not a coincidence. So those are kind of some of the key factors we talk to folks about, and just making sure your books are clean and there's no funny business going on with them, and they're clean and simple to understand, for buyers to get their heads around.
So what I'm hearing you say is it's not unlike what you should be doing to run a successful business day to day, right?
That's a novel idea, right?
Focus on your people, focus on your process, focus on your facilities, and making sure you have, things running smoothly.
That's right. Yeah. I mean, it's back to the conversation earlier about operating in tougher times, you actually seem to make better decisions and good business decisions to maximize and protect your bottom line and not overdo it on expenses. Well, why shouldn't we be doing that in good times and maximizing your bottom line and having those consistent processes in place? It's just easy when you're making a ton of money, more money than you expected, to spend more and get a little looser and take your eye off the ball, maybe not be at the business as much because you have all this extra dough running around and traveling the world type of thing. So it's kind of, you should always keep your eye on the ball, is what we said.
So go ahead, Jonathan.
You just mentioned it's so important to focus on the business, when things are really good. And, I think sometimes when the tide goes out or things get a little tougher, it really exposes a lot of people and a lot of business owners. And I'm curious right now, are you seeing any panic, in the market? Are you seeing some sellers rushing into the market that maybe you didn't anticipate because of that?
A little bit. I mean, there's, I think we expect this year to be pretty active. I mean, our pipeline is a lot larger than it was just last year. And, there's always timing of things, but we hear from the dealers we talk to on a regular basis that there's just, a lot more activity and a lot more deals out there. And it's because of that. There's folks that think, okay, I might have missed a window. I don't want to miss the window. Or there's a lot of dealers that were hanging on saying, this profit is so good. One more month. And so there's more sellers because business is tougher and they don't want to miss this wave because selling was on their mind. There's some fear about, geopolitical fear and the headwinds facing the industry on a macro basis that could impact, dealerships from a negative perspective long term. Nothing certain, but EV and all those sorts of things, regulatory changes and agency models, and just sort of some rubs with OEMs and things like that, and new entrants, Tesla and Rivian and BYD and things like that, kind of taking away share. So there's a lot of that talk. I'd say generally speaking, in times like this, you'll see some deals that don't get done, whereas it's easy to get any deal done when buyers willing to pay, whatever it took, during the best times in 21 and 22. Buyers are being a little tighter. They're being more diligent, focusing on what that earnings stream that they're buying really will be, more than ever. And then the flip side of that, some sellers want what we say is last year's money, right? So they say, well, I want to get paid what my friend got paid when they sold last year. And that's not the case anymore. Values have changed. They've come down some. Not
is that
everywhere.
A hard conversation to have with someone? Is that a hard concept for them to accept?
It's tough. It's we call it you have to be a rational seller. Our business is pretty unique. We don't actually accept every deal that comes our way. We'll only do a deal if we're on the same page with the seller, ultimately the client. And so we'll do a deep valuation and say, hey, this is what we think you're worth in the market. And if we're not on the same page with that client, then it's not really worth it because nothing's going to happen. No one's going to win. A few weeks ago, I got a call from someone who did a valuation. We say, hey, we think you're worth, I'm making this up, let's say $50 million. And the dealer said, that's great. We love you. We want to hire you, but I want $100 million. So we're not
sure, no problem.
We're not for you. We're not the right fit for you. And but someone that in the industry will tell them they'll get them 100 million to get hired, and then nobody wins, right? That deal ultimately doesn't.
But so that dealer that's saying, I want 100 million, you think they're basing that on, oh, I know another dealer who got a similar value last year or maybe 2 years ago, and I want that? Or what are they basing that number on? Just kind of a gut?
It could be that. It could be like all of our children are the best looking. Our kids are the best looking kids, best kids in the world, right? So it's, I think we see often that
there's a personal attachment.
Yeah, it's like this is their business that they built and put a lot of blood, sweat, and tears into, and it's really unique and really valuable to them, and maybe more valuable than what the market values it at. And so there's some of that, right? But yeah, there are too many rumors in our industry, the big small industry that we're in. It's really interesting. There's like 99% of the transactions out there, the data is not available. No one actually knows what the deal traded for. Save some of the really big public deals. Like I think the first transaction that was disclosed in like a really long time, probably since Lithia did the DCH deal, a dozen years ago, was when we did the Park Place transaction in 2020. It was a material transaction. It was the biggest in years in the industry that Asbury acquired. And because it was so material, Asbury as a public company had to disclose the pricing. But generally speaking, values are not disclosed. So nobody really knows what these traded for. And so the rumors get out there. And generally speaking, what people hear is wrong. Dealers, they like to say they got a lot more money for things, and the total price, including real estate and assets, got out there, and people think that's the blue sky value. And blue sky is typically about 60% of the total equation, right? And so that drives some of it. We see a lot of that where people just have the wrong information. The worst is when we hear, hey, I want 10 times because my friend got 10 times. So back to the multiple conversation.
I can see that.
I'll give you 10 times. Absolutely. 10 times something. It's kind of funny. It's a sophisticated yet sometimes unsophisticated kind of business from that perspective.
It's amazing how those numbers grow over time too. Like you'll hear about a transaction in January, you'll hear a number, and the same one 90 days later doubled.
That's right. Yeah, I just laugh.
So you mentioned, George, every dealership's different. I imagine every deal is different and so unique. Was there a situation where you were working through a deal and there was just something you did not expect? Or are these deals pretty much, not cookie cutter, but there's a predictable path that happens?
Generally, there's a predictable path. Like the typical deal is an asset deal, and it's. I was talking to a good friend in the industry, big company, the other day about this, and we were talking about how, there's such a volume of transactions in the industry, but they're not that complex. It's not rocket science if you understand what you're doing, and the general deal is structured the same. Generally, most deals are structured the same way. When we get into the really big ones or the 1% chance, sometimes we'll see a stock deal happen. Generally speaking, these are simple asset deals. Not a lot of risk from a legal perspective because you're just buying assets, so you're not inheriting any tax or legal or personnel kind of liability, right? Yes, there are sometimes surprises. The surprises aren't necessarily in the structure of the deal, but they're in, maybe some information that a seller didn't
the personality is involved. Things
like that based on the personalities. Yeah. And personalities are, it's, we'll do 100, our average transaction size is, well into the 9 figures. And we'll oftentimes see, dealers getting hundreds of millions of dollars and we're, focusing on like $50 at a closing table. It's really, really kind of interesting. Pretty unique.
So, George, I did want to get back to the report before we kind of wrap our conversation. And again, thank you so much for joining us and taking this time to talk through it. What were some of the takeaways that you have from the Presidio report? What are like the top 3 industry insights that you think you'd want to share?
Yeah. Well, I'm really proud of our survey that we do, which covers, I think well over 3,000 kind of dealerships in the industry based on the survey takers that responded. And, some interesting takeaways there are dealer sentiment just kind of overall about the industry and profitability, and then brand sentiment. And so the first, dealer sentiment, about 70% of dealers that took the survey think that 2023 profitability will be down. 50% of that 70 moderately, but the close to 20 significantly. So that's interesting. And again, we're going to see that vary greatly through the different brands. But a flip side of that, on the valuation question, only about 40% think that values are going to come down, and not significantly. And like a portion actually think values are going to go up. So I thought there was a little bit of a kind of
conflicting viewpoints there.
Viewpoints there, yeah. Which tells you that the takeaway for me on that is that investors, buyers that are in this for the long term, dealers believe in the model long term and think this is a great place to invest their money, and believe that over time, all things go up. And so that was a good takeaway. Brand sentiment. Not a surprise. Toyota and Lexus right at the top every time. Like Toyota number one. They are an amazing company, a tremendous partner, support their dealers, and quite frankly, their EV hybrid kind of belief system, is what really everyone should be thinking about, what our government should be thinking about, from my personal opinion. And it's really, more balanced. And, there's no surprise why that Toyota dealers are doing really well and are bucking the trend is because of that great partnership and that great support. Was a little bit surprised by a few of the brand rankings there.
You had some brands that jumped up.
Yeah, a couple that jumped up. Subaru and Honda jumped up.
Yeah.
Not surprised by that, actually. In particular, Subaru was a great brand. And then, Mercedes ticked down just a little bit. And we think that's driven by EV approach and sort of OEM dealer relations, but nothing significant there. I think those are key drivers. The three top headwinds that came up in that survey: vehicle affordability, interest rates, and then EV confusion, I'll call it. And so those really interesting takeaways are our NCM partnership and the data that we have that we're able to produce for the industry in that report, we think is really compelling, because until then, only the public company data was out there. And again, that's 6% of the industry, and that's, six owners, right? Versus, closer to 20% with, thousands of dealerships. So a different cross section. So we're kind of excited to be able to show that information, and given our spin and our take on valuation, which is more robust and a little different than others in the industry. And we just think that there's not a cookie cutter approach like we spoke about earlier. And you have to triangulate and look at things from all different angles and very sort of in depth and from a sophisticated perspective. And, those are kind of the key things we're excited about. We also have a tech group that we support, do a lot of business helping, companies inside the auto industry that are either tech companies or any company that supports dealerships. We do a lot of capital raising and M&A transaction work for companies like that. So we talk a lot about that stuff as well, not just dealerships. Because again, the industry is evolving, and tech is a key component. AI is a hot button right now. We're fortunate to support a really innovative AI company that is a leader in the industry right now. That's helping dealerships transform their businesses. So pretty robust and diverse report that we're really excited to be able to put out there.
Well, I think that's in line with a lot of what we're hearing from dealers and in the industry. And I would encourage everyone to check out Presidio's latest report. A ton of insights, George, as you just shared, among others. Really robust piece about our business. So great job to you and the team again.
Well, thank you. Really appreciate it.
All right, George, we're going to wrap up our conversation with a fun new segment that we're experimenting with here. So appreciate you being our guinea pig. Okay. We're calling this Best Bets. Now, this may have something to do with the fact that I have somewhat of a degenerate habit of gambling, but it's not too bad with all the apps out there today. It's very manageable. So don't worry about me, George.
I'm a little worried.
Jonathan's a little worried, but I promise you, it's very manageable. So
as long as you don't control the checkbook at JM&A.
That's right. I am not in finance. Let me just say that. best bets. Everyone's looking for an edge. Everyone's looking for some advice. We're going to throw out some trends or some things that are happening in the industry, what people are saying and talking about, and ask you as a finance professional, as an industry professional, would you put your money on this? Would you bet on it? Right?
Yeah.
Why don't you kick us off, Jonathan, on the first one?
So, George, you brought up EVs. I want to talk about EVs a little bit. So, I want to talk about EV adoption and a prediction. Some people are pushing some things that people are saying. EV adoption will grow and reach 25% by the end of 2027. Over or under?
Ooh,
that's a good one, right?
Good one. I say under.
Under. All right. So your best bet is under 25% by 2027.
I'm not a huge EV fan myself, so maybe that's just by these are my personal opinions.
These views are not brought to you by the Presidio Group.
That's right. These opinions are not brought by Presidio, and this is not investment advice. I'm supposed to say all that. It's a personal opinion. It's I just went to lunch with a colleague of mine. He has a Rivian. That's a pretty cool car. It's a niche vehicle, but really cool looking. I have a few vehicles. None of them are EV. So I'm not there, but there's some cool product out there.
Okay. So we heard it from George.
All right.
Next one. We were talking about deals and, of course, the M&A market. Public groups will continue to shrink over the next several years and not grow. Public groups will continue to shrink and not grow.
Yeah, that's a weird question. I mean, shrink would mean like they're selling and not buying?
Correct.
Oh, I don't. Generally speaking, the history of the public companies is that they're in the business to own dealerships. I think public companies, I won't answer that question, but I'll answer it this way. Sorry, I'm messing up your game.
It's okay, George. Like I said, it's an experiment. We haven't really worked out all the kinks.
It's a little bit of a trick question.
It's a little bit of a trick question.
They're all unique. They're all different, the six publics, but they have ultimately, fiduciary responsibility to shareholders to allocate capital and provide a return to their investors. And, I think we'll see a balance. We talked about this in our report, actually. Expect to see publics potentially be a little, be balanced with their capital allocation. There are cases where you may see stock buybacks because, their stock is trading at a lower value than what they could buy deals at. Some of the publics have dividends. There's investment in facilities, things like that. And then for the right deal, I think publics are always interested in looking at deals and growing. As long as it's the right opportunity and then a good fit and a good long-term kind of ROI for that business. So I think publics will be balanced in their approach, as they should be, and that they always have been. But their public companies are here to own dealerships, own and operate dealerships, and ultimately grow either organically or through acquisition.
So we're going to avoid that bet. That is not a best bet.
Yeah, I'd say so.
Okay. Last one, George. Also on the EV topic. There's been a lot in the news about BYD, right? And their entrance into the U.S. market. BYD will catch Tesla in the U.S. and gain share in the next 3 years.
No idea.
Over or under on 3 years?
I don't. No idea.
You're not even going to venture a guess?
I mean, look, BYD, they're a pretty good company. I mean, they're pretty, and I hear good things about the vehicle. I haven't seen one in person, but everything you read, the price point's going to be competitive, really competitive. But, we have a lot of OEMs here that have invested a lot in EV technology and EV and have a lot of product. I mean, everywhere you see product coming. And so, there's going to be a lot of competition. I don't know how the geopolitical world will play out with tariffs and BYD getting in here or not. No idea. But it's competitive business, and dealers continue to innovate and stave off and take on competition.
All right. Well, you heard the insights.
That was a politically correct answer there.
Very politically correct. And I understand none of these viewpoints are brought to you by Presidio Group. George, we can't thank you enough for being our first guest on the new season. Again, for everyone listening, absolutely recommend checking out the Presidio Industry Report. Great insights, great conversation. We really appreciate the time, George.
Thank you both. Really appreciate it. Thanks for having me. Enjoyed it.
Thank you, George.
We really appreciate you joining us today on The Walk Around, and we hope you enjoyed the episode. Please be sure to like, share, subscribe, and follow us on Apple, Spotify, YouTube, or wherever you get your podcasts. All episodes are brought to you by the JM&A Group, and a special thanks to our team, Caitlin Swanson, James Gahn, and Michaela Gerritsen. We look forward to seeing you next time on The Walk Around.